Good morning, everybody. Welcome to today's 1 Million by 1 Million Strategy Roundtable for Entrepreneurs. 1M1M, as you know, is the first and only global virtual accelerator in the world. Our mission is to help 1 million entrepreneurs reach $1 million and beyond in annual revenue, build $1 trillion of global GDP, and 10 million jobs. And we are here almost every week. This is going to be our last roundtable for the year because of the holidays, but barring holidays, we are here almost every week. So this is the 287th session of our free public roundtables, and we have many, many more than that private roundtables, which is for our premium program members only. So we do this mode of mentoring work and communication, exchange of ideas work using this format very effectively and very efficiently, actually. You know, we get a lot done in a 90-minute window by using this format. So I recommend to all of you highly to consider, you know, not having to drive and plod through 90 minutes of commute and instead use that 90 minutes doing this kind of stuff. We will have the recording available for you later. If you're tweeting the show today, live tweeting or tweeting afterwards, please use the hashtag 1M1M. Join us on Twitter at 1M1M and at Romana, at 1M by 1M, sorry, and at Romana, and we publish a lot of very interesting content continuously, actually. Our Roundtable channel is on YouTube, 1M1M Roundtable. This recording will be available there. And we actually have recordings of all prior sessions there. So if you find this interesting, you can also go back and check prior sessions. These are the call-in instructions. We're not ready for call-in yet. We have a guest. I will introduce you shortly, but please make a note of these numbers. And we want you to participate. This is a roundtable. This is not a unidirectional lecture or a talk show. It is a participating program. So we want you to weigh in. We want you to ask questions. We want you to make comments. So use the public chat as well during the sessions, and also when we open up the line for you to call in, please do consider calling in. Let me introduce you to Ashmeet Sidana, founder and managing partner of Engineering Capital. Ashmeet is currently a VC entrepreneur. He has just started this new fund, and he's going to tell us about what he sees as the changes in the venture capital industry. So as entrepreneurs, just like we are constantly navigating the technology trends and what's happening on the technology side of the industry or on the business side of the industry, on the market side of the industry, we also need to understand what's happening on the financing side of the industry. So I invited Ashmeet, who's an incredibly thoughtful person, to share with us his observations about what's happening on the venture capital side. Ashmeet, welcome. We're very pleased to have you here, and thank you for making the time.
Thank you, Samana. It's a pleasure to be here, and I'm wondering if, since this is the last session for the year, whether you've saved the best for last.
Yes, I'm sure I have. So Ashmeet, you come from a traditional venture capital background. Of course, you come from a very heavy-duty technology background, and then you made a stop in the traditional venture capital industry. Tell us what is your observation or analysis of the venture business today?
Well, overall, I would say the venture business is thriving. There's been a banner year for distributions this year. LPs are very happy. It's been a banner year for fundraising, lots of new capital coming in, and most importantly, lots of new companies being created. So innovation is active, funding is active, exits are active, and so overall the business is thriving. There are some underlying changes which we can get into structurally, and why I'm an entrepreneur now in the venture business and some of the changes which we are seeing, two of which the most important which get talked about are, one, the reduction in capital to start a company, the so-called lean startup movement, the fact that you can start very quickly, but also the total amount of capital which it takes to build a company to success and exit. You know, we hear about 500 million and billion-dollar rounds. And so it's really these two trends which seemingly seem to contradict each other. that is reshaping the venture industry.
So let's double-click down on these two trends. Of course, our audience is very familiar with both trends, actually, because we cover both trends extensively. But let's analyze those. The lean startup movement is something that is very core to our world. You know, we operate in the very early stages of the entrepreneurship life cycle, and we propagate the message of lean startup and capital efficient bootstrap startups very, very aggressively. So how does that impact the venture capital industry today?
I think the biggest change lean startups have brought into the industry is the success and the creation of seed funds. I myself run a seed fund. Engineering Capital is focused on the seed stage because it takes a small amount of capital to get a company started, prove product market fit. That's really what the lean startup movement is about. I'm very proud to share with you that Steve Blank, who is one of the key thinkers in this, you could argue is the founder of the lean startup movement, is an advisor and an investor of Engineering Capital. And so we've thought very carefully about what will be the impact of lean startups, where will it grow. And it's this ability to start a company quickly, iterate quickly, get product market fit, which is the heart of the lean startup movement. What is interesting about Engineering Capital in particular is that we are focused on the infrastructure side. The lean startup movement got a lot of publicity and press on the consumer side, and people talk about writing iPhone applications or perhaps even building, Web 2.0 or mobile applications in the lean format. What is interesting that I am seeing now is that on core technology, hardcore infrastructure, we are seeing lean technologies get applied.
So now, one trend that we see is that even the seed funds or even angel investors these days expect that entrepreneurs are going to bootstrap ahead of time before they actually come to raise the seed capital. So there is this whole pre-seed activity of validation, of seeking product market fit, and then even the earliest stage investors are looking for businesses to invest in that have already achieved product market fit. Can you comment on that?
Sure. This is actually not a new trend. It has always been true that, every investor wants to see as much progress as possible before they come in. Of course, the more the progress, the more ahead they are, the lower the risk in the investment. And so investors have always wanted to see it. However, depending on the state of the market, whether the market is bullish or ebullient like it is right now, you'll perhaps see people take more risk. When times are tough, cash is tight, you'll see people take fewer risk and they want to see more progress in front. So this is not a new trend. We've seen it before. The important thing to keep in mind is that building a startup is an evolution that occurs from the concept of an idea. When a person wakes up one day and says, I'm going to start a company, all the way to when they have revenues, perhaps they go public, perhaps they get sold, and at some point they leave that company, which can be a journey of 5, 10, 15, or 50 years in some case. And so financings are simply events along that journey, and they are really the side effect of that journey. And so starting with the core issue, what's the company I'm building, what's the business I'm going to grow, what change am I going to create in the world, and then you do financing events along the way. And yes, there's a seed financing, perhaps there's a Series A, Series B, there's debt and equity which you raise along the ways. Even an IPO is just a financing event. All the great entrepreneurs, Bill Gates, Mark Zuckerberg, Larry Page, Steve Jobs, they continue to run their companies well after even the IPO.
So the other side of this coin is this whole explosion in capital in the late stage financing, and then on very unreasonable terms, on very unreasonable fundamentals, I personally believe that trend is going to slow down next year, just because a lot of these companies that have bloated valuations and weak fundamentals are going to kind of implode in the public market, and we are seeing a lot of that happening already. I just started writing a series called From Unicorn to Unicorp, and we covered a couple of companies already that are going through this, rather painful process. Now, what is your analysis of why why this tendency of funding non-fundamentally sound companies at such heavy levels happening? We've seen this before. It happened in the dot-com era. It's happening again. Have we not learned anything?
Well, there are two different things which happened in the dot-com era in the way in which things are different right now. But first, let me agree with you that there are companies which have raised money at very high valuations on very poor fundamentals, and so we will see unicorpses. I love that word. So we will certainly see some failures which will happen over there, but conversely, we will also see successes. There are companies, I mean, Facebook was arguably a company that people thought was overvalued all along the way, but it has proved to be
overvalued, but it never lacked fundamentals, though. It always had very good, good fundamentals.
It had very good fundamentals in terms of user traction, but it didn't have any revenues, it didn't have any profits.
No, it had revenues, it had good revenues.
No, I'm talking in the much earlier days, when I'm talking about at the 1 billion mark and the 10 billion mark when valuations were done, which were pre-revenue valuations for
those
Facebook.
were not pre-revenue valuations. Not on Facebook. No, Facebook aside, but I just wrote a piece, actually. I went through all the numbers on Facebook. You can look it up on my, on my blog and on LinkedIn. But Facebook aside, there are a lot of companies who are getting these ridiculous valuations with no fundamentals. So what is going on?
I agree with you on the basic point that there are companies which have unsustainable businesses, so to speak, businesses in quotes, which have raised money at very high valuations, and let's call a spade a spade. A company that I worry a lot about, for example, is Dropbox. I don't understand the sustainable competitive differentiation that Dropbox has. Why is this company valued so highly? We can argue that that's probably not a good idea. We may be proved wrong. These things can change. But today, based on the little bit that I know about Dropbox, I worry about the valuation it has. But let's understand the underlying trend. Why did so much money come into late-stage valuations in these companies? This was driven by two underlying forces. One, because of regulatory and market changes in the U.S., it became less attractive for CEOs to take companies public. Basically, we have raised the bar so high on regulatory compliance, partly as a reaction to Enron and some of the bad behavior that occurred after the dot-com, during and after the dot-com boom, that now it's very unattractive to run a public company. I serve on many boards. I have CEOs. I talk to them all the time, and they're like, I don't want to deal with I don't want to run a public company. I don't want to be on a public board. It's just really, really hard. So one is this raising of the pain threshold that I think has gone too far from the government side. Because of that, companies moved, it became much less attractive, and so people started looking for sources of private capital. Coincidentally, at the same time, we had a big financial crash, interest rates came down to zero. There's a lot of capital, and the Federal Reserve and all the other central banks flooded the market with capital. So there's an enormous amount of capital which is available now, which has to go and find yield. Interest rates are effectively zero, barring the small raise last night from the Federal Reserve. And so there's a lot of money chasing yield, and the only place where yield was available, since you couldn't do it in bonds, you couldn't do it in fixed income, you couldn't do it in all the traditional asset classes, it started coming into private companies. And that is why these two things coming together is what created what you could argue is a bubble, or this very late stage frothy market which we've seen, where there will be some irrational behavior that will occur.
But you know that the truth is, though, the public market is not in a bubble, right? The public market actually is reasonably sane these days. And most of these companies who are getting this ridiculous private market valuations would not be able to go public because they don't have the numbers, the fundamentals to go public.
And that is bad behavior. So I agree completely. That is the case. That is happening in certain cases. It's a case-by-case basis. There are also great companies which get created. And again, as an entrepreneur, what we have to keep in mind is markets come and markets go. It's a cyclic. The markets are always cyclic. Economies are always cyclic. Businesses don't have to be cyclic. If you can build a company which has true technology innovation, which has a true sustainable barrier to entry and a competitive advantage, where you are creating value for people, it doesn't matter. It doesn't matter what the markets are. It doesn't matter how, what the regulatory environment is. You can succeed if you have those core ingredients. And what I'm very excited about is the change and the innovation which I have been seeing in the data center space, in the cloud space, in the infrastructure space. That change is so dramatic, and there is such a large disruption which is about to occur over there, which is why I started my firm, and obviously I'm focused on that space.
So we want to talk about that in a lot more depth. I just want to underscore what you just said with one point for our audience. You know, I was recently in Europe, and in Vienna I went to see a performance of Bernard Shaw's Pygmalion. And I don't know how many of you are intimately familiar with Pygmalion. There is a point where this dustman who is given, who makes no money, he's very poor, and he's kind of poor and free. He has this great off-the-wall philosophy of life, very cavalier, and he drinks and he does whatever he wants. And then suddenly, he has been given this 3,000 pound stipend, and he has to be, he's intimidated. He cannot refuse this money, even though he loses his freedom in the process. And there are these great lines that Bernard Shaw delivers through him about that process of somebody losing his freedom to middle-class morality, as he calls it. Now, the reason I bring this example up is many entrepreneurs in our world are being offered irrational amounts of money. And most first-time entrepreneurs especially, even latest, serial entrepreneurs, don't have the, they get intimidated by those huge sums of money being offered, and they lose their head. You need a very serious level of internal compass, seriously strong level of internal compass to be able to withstand and turn down these kinds of overtures, which are actually in the long run not healthy for you. Now, if you actually, Maureen, I think, has shared my very recent Facebook post, how did Mark Zuckerberg retain 26% equity in Facebook after raising so much money? Take a look at that, and take a look at how much money was being thrown at Zuckerberg and how he managed to navigate through that. And I just, recently, because in the process of writing this post, I went through every single round of financing, and there is this, for somebody so young, there's this tremendous amount of steadiness in how he has navigated through that, and there's something to learn from that. So if you are faced with this scenario where you don't really have the fundamentals to support the kind of funding that you are being offered, and you are losing control of the destiny of the company through rounds of financing that are unreasonable, please pause. It is okay to turn down huge amounts of money and work within reason, and your chances of success are actually going to be a lot higher if you act with some discretion in those circumstances. We know of some entrepreneurs who have been associated with our program who are going through this process of huge amounts of money being thrown at them, and they're not able to keep their heads really cool. All right.
Samana, there's a great wisdom in what you're saying. If I may add to what you're saying, that it is not only something that entrepreneurs should think about doing. I would say that you are required to say no to money on the path to success. Every company which is successful at some point says no to large amounts of money along the way. And here's the way I visualize it with my CEOs. What I tell them is, you're running a marathon. Any money you raise is candy. The real thing that you want is whole wheat bread, lots of protein. That's how you run marathons. You don't run marathons by eating candy. Raising money is candy. Where is the protein? Where is the whole wheat? That is revenues and profits.
Yes.
that's what you have to go and get. So that is the analogy that I always make. Completely agree with you. And I haven't seen Pygmalion, but the wisdom of middle-class morality was brought to me by the Hollywood version of that, which is the movie My Fair Lady, where I think it's Rex Harrison who delivers the money to this artist, and then you get this feedback. Completely agree with the wisdom of what you're saying.
So I'm going to use your analogy. I love the analogy of protein and whole wheat bread versus this candy. Our line on that is entrepreneurship equals customers, revenues, and profits. Financing is optional, exit is optional. So perfect. Ashmeet, tell us about engineering capital and the core focus that you've chosen, and what are the trends, what are you seeing, and what are the discontinuities that you think are going to yield great companies in the infrastructure space?
Thank you, Shramana. There's a lot of disruptions happening right now in the mobile space, in the consumer space, in the finance space. I happen to be focused on a very different disruption, which I noticed about 2 years ago, which started with a very simple observation, which is that if you walk into the best data centers in the world today, the types of data centers that are run by Facebook, Google, Amazon, you will find that there are no servers from HP, IBM, or Dell. There are no switches from Cisco or Juniper. There is no storage from EMC or NetApp. There are no operating systems from Microsoft or VMware in any of these data centers. And I can go on and on, naming well-known, excellent, successful technology companies that appear to be the leaders in their space, which don't provide any of the technology to these fabulous data centers. And so these excellent, wonderful new data centers are more efficient, cheaper, faster, and so it was inevitable that there will be a large disruption which will happen, and that's the space that I have been investing in. I think new companies will be created over here. They will be created in the security space, in the monitoring and management space, in the storage space, and even in the core compute space. And so I look at all of them. These tend to be very technical companies. Obviously, they must have a deep technical component, but also real business models, and that's what I look for.
Ashmeet, can you give us a couple of examples of companies that you've invested in, and also walk us through the investment thesis of why you chose to invest in those companies? I'd like our audience to learn how you evaluate companies.
Sure. So let's start with an example. One of my portfolio companies is Menlo Security. Menlo Security was started by Amir Ben Afram and Purnima. Amir was a vice president at Juniper who was a successful entrepreneur who had previously done a company called Altor Networks. And he realized, he had the observation that endpoint security is fundamentally broken. We have been selling antivirus. Everybody installs antivirus on their desktops, and it really hasn't solved the problem. We still have breaches. We still have people, hackers breaking in. And so there was a fundamental new approach needed to solve this problem. He worked with Professor Song from Berkeley, and they came up with a fundamental new approach where we actually take all traffic coming in from the internet, whether it's web, whether it's email, and all of it runs in the cloud, and there is only a display version of that which is provided to the desktop, to the end customer. So this is targeted only at large enterprises today. Eventually, we think we will also go after the consumer market. But it 100% guarantees that there cannot be a breach on your desktop in an enterprise because we never let anything run on the desktop. There is no JavaScript, there is no Java, there is no endpoint code, there's nothing running on the endpoint. And so it's a very successful company. I was a seed investor in them, raised a modest amount of money, used the lean startup approach, got to some product market fit very quickly on that money, then raised a Series A from General Catalyst, and then Sutter Hill Ventures, and so, continues to grow and build a really large business now.
And this company is selling to enterprises?
Yes. Menlo Security today is focused primarily on large enterprises. So if you're a bank, if you're a financial services enterprise, that is our target market. You have to be very, very careful what you do. And yet you have tens of thousands, in some cases hundreds of thousands of employees who have to run desktops, who have to be able to interact with the web, who have to, of course, work with email. There is no modern business that can run without access to the web or to email, and yet antivirus was not solving the problem. So a radical new technology with a fundamentally new architecture, creating real business value in what we've been able to create with Menlo Security. Real credit to Amir, Purnima, and the rest of the team there.
And are all your investments in engineering capital focused on enterprise-facing businesses?
They don't have to be. That is the case right now. Really, engineering capital will invest in a great entrepreneur with a great technical idea who can fundamentally disrupt the infrastructure space. That's what I'm looking for. If you have a credible business plan, I'm interested in you. And for me, credible business plans have a path to profits. So whether that profit comes because you sell to a consumer or an enterprise, both are valid approaches, and I'm open to either.
Okay. Why don't we do one more example from your portfolio, and then we'll switch to the other next topic.
Sure. So another investment I have is in a company called Zockets. This is a very, very technical play. It is a new memory architecture, and what it lets you do is run Hadoop or Spark or Tez or any of these big data platforms up to 100 times faster. Fundamental innovation, still at the seed stage. I recently invested in the company, and we still have technical risk, so we haven't yet proved that this will work. But if it does work, I think it will radically change how people run big data workloads.
And what are you looking for in the founders that you choose to invest in?
That is my favorite topic because it is the most important thing, especially working at the seed stage where the market is still unproven, the technology is still unproven. Often we don't even have a clear idea of exactly what the product will be when I'm investing over there. So it really is about the founders. It really is about the team that makes the difference. I continue to believe that Apple would not exist without Steve Jobs, Microsoft would not exist without Bill Gates, Facebook would not exist without Mark Zuckerberg, Oracle would not exist without Larry Ellison, and Hewlett and Packard would not have existed without Dave and Bill. And so it really is about the founders. And what is it that makes these people so special, and what do I look for? First, I look for the fundamentals. Are they intelligent? Are they hardworking? Perhaps they have a good education, not required, but useful to have. Do they have good work habits? Are they ambitious? Are they motivated? These are basic skills. If you don't have these skills, I don't think you can succeed as an entrepreneur. But the reality is a large number of people have these skills and yet don't succeed. So what is the additional component that makes an entrepreneur successful? Here are some of the attributes. Great entrepreneurs have the ability to have a big vision, to dream, think big, see the future before other people can, and then bring it and relate it all the way back to reality today. If you can only dream big dreams, perhaps you're hallucinating. You are not a great entrepreneur. If you are only in the weeds and looking at the details, then you can't have the big vision. You need to be able to do both. Great entrepreneurs also have contradictory attributes. They are incredibly persistent. They are incredibly diligent. They can take many, many no's and continue to move forward with their own vision. Yet, they are also great listeners. They know when to understand what the customer wants, what users want, and how to change what they're doing. We talked about Facebook earlier. Look how much it has changed over the years. It started as an application on universities. Look at where Facebook is today. What does it do? It has iterated all along the way at a very rapid pace. Great entrepreneurs have the ability to change path just like this. Microsoft started as a compiler company, became an operating system company, and really became a productivity company after that. Great entrepreneurs have the ability to make this change while facing criticism and negative feedback from people saying that what they're dreaming about is not possible. And so looking for these contradictory attributes is essential.
And as a VC, how do you figure these things out? These are not easy to figure out.
Well, my answer to that is that this comes from good judgment, and good judgment comes from bad experiences. So you have to work hard. You have to try things. As you can see over here, I have no shortage of gray hair. Some of these have come from having done well, but some of them have also come from making mistakes. And so it really comes from that, and I don't think we have yet distilled this into a formula or a method. I can tell you that you can spend an hour with a person and walk away with a deep impression of, is this person truly motivated, or perhaps they're just interested in status. You know, you talk to a person who wants to be a CEO because they're interested in status, and you want to talk to a CEO who wants to change the world, and you want to talk to a CEO who wants to make other people successful. Three very different views why you meet people who pursue that path. So that's what you look for. It comes from experience. I've actually just come back from a machine learning conference. I continue to be astounded at the amount of progress that machine learning is making, and some of these new approaches we are seeing in HR and people management. You know, Google is very active. Netflix has a very different approach in how they manage people. And so I think eventually this will get automated, but for now it's just judgment, and it's really just experience.
You know, one of my observations about the world, about society in general, is that authenticity is rare. The world is actually dominated by hypocrisy. So now, as a VC, you're going to need to figure out how much of what the person is telling you is selling and pitching and you know, the surface stuff versus what really is inside. And that's not an easy thing to do in short amounts of time.
It's not easy, but it's also not hard. You know, companies do it all the time. They just do it at different levels. You know, when a president appoints his cabinet, and when a president, you know, picks the Secretary of State, they're making the same decision. They're making a hiring decision. They're making a judgment call.
And they're making spectacularly bad decisions, I think, on a continuous basis.
Because it is hard, right?
Because it is hard.
Right.
I mean, look at the whole circus going on at Yahoo over and over and over again. This is like, this company cannot find a CEO who works.
You're absolutely right. It's a very hard business. It is an error-prone business. That is why VCs, politicians, CEOs, everybody makes mistakes when they do it. Even mafia dons make mistakes. Even they go through recruiting decisions when they hire people. But it's okay to fail as long as you're clear about the goal and you can iterate towards success. A great example for that is Abraham Lincoln. He was president. He was fighting a civil war. He went through many generals. He had to choose general after general after general. So it is a great skill to be able to hire people and find the right person for the right fit. Take another example of a great recruiting decision that was made. We have a president in Second World War who has to choose who is going to be the commander for the entire Allied forces. Okay, you know who I'm talking about, Eisenhower, a person who eventually went on to become a president himself. Eisenhower was not next in line to be promoted. It was a controversial decision, but what a great decision, right? So these decisions have been made through history by people in different contexts, whether it's war, politics, business, recruiting. The rules are the same. We are recruiting people, we are working with people, building teams. Right now, I can say it comes from judgment, it comes from experience. You know, I've interviewed hundreds, probably thousands of people, you know, over the years for jobs, and I've made my share of mistakes. I've had to fire people. So this is not a error-free process, but you spend some time, you learn about people, and you can come to some good judgment about it.
All right, Ashmeet, I hear that you're going to stay for the pitches. We're going to listen to some...
Yes, I'm happy to join. I'm looking forward to it.
All right, folks, we're going to give you a little bit of preparation before we start the entrepreneur mentoring session. So you have to understand one thing here. We are on your side. So whatever discussion we have, even if you get negative feedback, if you get critique, not criticism, critique, constructive critique of your ideas, it is with the spirit of wanting you to succeed. So if you don't like the feedback, that's okay. It's really, again, you have to use your judgment, what part of the feedback you're going to take, what part of the feedback you're going to work into your process. But do think about the feedback, because the people who are giving you the feedback are experienced people, and they have good intentions vis-a-vis you. Now, another thing that I would like to say is that we are not screening who's presenting. So this really, 1 million by 1 million, we have done our best to make it a democratic platform. So we are trying to democratize entrepreneurship education and incubation. So please set your expectations accordingly that the pitches are going to be raw, the pitches are going to be, not really these crisp, polished pitches. These are people who are doing stuff that are works in progress, and this is a working session. So we've invited you to participate in a working session where we're all going to work together and help every person who's pitching make progress. That's the spirit of the whole process here. So with that in mind, let's get started, and please participate. Everybody in the room is welcome to, Ashmeet and I are going to be on camera and audio, but you are all welcome to chip in the public chat and share your thoughts, and the entrepreneurs who are going to be pitching will be wanting to engage with you in public chat as well. All right, so we're going to start with Scott Gerbasi and Martin Kostman, co-founders of Schedule 101. Martin is presenting, I believe?
Correct. Hi.
Hi. Go ahead, Martin.
Thanks. It was a great talk. So I'm Martin Kostman. I'm co-founder. Scott is my business partner. He lives in San Diego. I actually live in Mont-Tremblant, north of Montreal, but I'd like to put the development, which is currently in the United States, in Ottawa, Canada. So Scott's background is he worked in restaurants for 35 years. We're both 55, 56 years old. So Scott, over a 10-year period, from the pain of being a restaurant manager, built a system on the side which he put into a bunch of restaurants in LA and San Diego. He moved from LA to San Diego, and I came in a few years back to turn this into a business and ended up with a partner strategy. So this is still the first slide. My background is I worked for vendors, distributors, and then I quit. I started Sun Microsystems Ottawa branch in 1986. And I left after signing the first VAR business deal and launched a VAR business as the second one in Canada. So I ran that business for 10, 15 years, and we did development, integration. We had Fortune 100 clients, stuff like that. So I went through a few businesses, and I found Scott. And in fact, one of the businesses before this one was IT security. We started a security practice and dealt with the federal government. And in fact, you mentioned Juniper, and we were instrumental in helping the launch of Q1 Labs, which was a network security business. So I have a fair amount of IT background. Thanks. So Schedule 101, you can find us, just Google it, and we can go to the next slide. So what's our business? What Scott's determined through his career is that restaurants are chaos. And what his system does, and we're not alone in this market, is we help and turn what we feel into something we refer to as controlled chaos. Those red, blue, and green buttons at the bottom are the trend in the industry, which are the shift, swap, drop, and add. It says switch, if you can see it, but those red, blue, and green buttons, they say shift, swap, drop, and add. So that obviously, by computerizing a schedule and putting it online in the cloud, you're streamlining the process of phone calls and looking for people and everything else. And there are other features like that. So that's what we say is our business is to help streamline operations. We feel through improved communications. We know this boosts morale. We know there's a trend. Well, this reduces conflicts, and turnover is very prevalent and expensive in the restaurant and in any retail, but we're targeting restaurants for now because that's Scott's background. We could go to other verticals. And it drives profit and revenues because when you got happy people who know their jobs and know their business, they do a better job and the guests have a better experience. So the next slide goes into a little more detail. So our value prop, there are a number of features in the system, which obviously we're not going to get into today, but the value proposition is, along the lines of, a single glance, you can see a lot of information. When you hover over those colors, which are color-coded for information about the staff that are on the roster for the day, et cetera, it improves productivity. So also, this whole business of building a schedule of lots of employees, and our sweet spot is 50 to 100 employees, it's applicable to 10 or 15 or even 20 employee units, but there are restaurants that have hundreds of employees. You don't realize it, but they're multiple shifts, so you just multiply by 2 or 3 shifts, and you got a big number sometimes. So building a schedule is an art and a science, and it's challenging. You speak to anybody in that business, and they'll tell you how hard and painful it is, and throw at it that you're building a schedule to get the right amount of people. It's bandwidth, right? Because you got waiters is one thing, but if you add a lot of bookings, then you have to actually think about the number of plates that are there in the restaurant, and forks and knives and dishwashers. It's a bandwidth issue. So labor percentage scheduling is what we say we're providing in the scheduling aspect of our system, and it's all about scheduling for profit. So as I said before, there are a number of features for addressing. Once you've built that schedule for a good labor percentage number and you release it, and this is my partner's, business partner's expertise. I put him up against some of the best in the industry, and he knows his business. He knows this stuff cold. Is that, he's designed it to be easy to use, and there are a number of features in there to make the whole process easier. In other words, you built it for the labor percentage, but then somebody, I can't work today at the last minute. You got a problem, right? It used to be a nightmare. So it's much easier with the trend today of these types of systems. Next slide, please. So obviously we have a demo. We have multiple demos. This link here goes actually to one we built for our partners, and I'll get to that in a moment. So our next step actually, which is going to cut, and it's a trend also, which is going to cut costs, is sending the schedule to the point of sale where there's a clock or payroll, because you can mitigate clock in, clock out abuses in real time. So a manager can see that someone's trying to clock in early or clock out late, run the numbers, minimum wage going up. That becomes a very big number when you have like 50 stores and 5,000 people or whatever the number might be. So that's why I say coming soon to your point of sale and payroll systems. Next slide, please. Okay, so it's subscription-based. Money comes from payments per month. It's a recurring revenue model. Obviously, that's SaaS. What I've done, and this is, it took me 3 years to do it, but I've set up partners. So I'm giving away revenue so that I don't have to build a sales force. And I've signed up more partners than we can deliver on, and that's why I'm on this program today. So we've got users, but we're pre-revenue. I want to make that very clear, but we're starting to get it now because I have my first partner in place. It took him a while, but we've integrated, and he's not actually a point of sale or a payroll vendor, but he's a complementary vendor, and he's bringing us customers. So with that, we can focus on software development of our future plans, which I will not address in this presentation today, and it's all about integrations. Integrations are.
Martin, you're breaking away. We can't hear you. Martin, we cannot hear you.
Is there a way to use WebEx to communicate? Hello?
Yes.
Is there a way to use WebEx to communicate?
I'm not sure what's going on, but we are, it sounds like Maureen says it sounds like your phone is dying. Do you have another phone or another handset or something that's got more juice?
I can call back in through a different line. It'll take 30 seconds.
Okay, do that, because this is not going to, we can't hear you.
It was, okay, just a moment. I'll call right now.
So while Mike is dialing in, audience, what do you think of this presentation so far? What are you learning and what are you observing?
Are you asking me, Shramana?
No, Ashmeet, I'm going to ask you, but I'm going to ask you once Mike is back on the call. I'm asking the audience right now.
Thank you.
Audience is going to be typing, so Mike can pick it up once he's back on. You and I would, he'll get it in the recording, but I want to actually talk to him. Michelle Ellis says it's a great product. I'm efficient.
Can you hear me? Can you hear me?
Yes. Is that Mike?
Okay, good. Yes, it's Martin.
All right.
I
perfect.
apologize. You can thank Vonage for that. I thought we fixed it. Okay, so how much did you get? We're on channel strategy. I'll go as fast as I can to catch up.
Yeah, go on channel strategy. We didn't get any of the channel strategy, actually.
Okay, apologize. So obviously we're talking about integrating payroll and point of sale for the clock and other data. And I've signed up agreements with partners like ADP and other point of sale companies that have a clock, because the idea is you mitigate employee abuses of clocking in and clocking out, which is a big cost money factor. So we're aiming at a pure channel strategy, channel play, partner play, and we want to leverage. They're all different.
I have a question.
Yes.
I have a question on that. ADP, Paychex, these kinds of companies are actually engaging with you, and they are. Is
Yes.
there something going on that they are promoting this, selling this? Is there some evidence that they are actually selling?
I was just about to address this. I'll go through it and you'll understand, but to address that directly, we're in the ADP marketplace. You can search Schedule 101. It's not bringing us much yet because none of them will do a lot until we do the integration, which again is why I'm presenting today. I need help and we need some cash to do those integrations. We have a product, but we don't have an API. I want to write an API and I want to write those connectors, etc. We'll get to it. Very good question. So they're all different. Clover is an example. It's owned by First Data, a $2.5 trillion company. It's a point of sale with a clock. We're in the app marketplace, but they are waiting for us to do the connection with their system, and that I'm pretty sure is going to bring in some good customers. They're waiting for it. I went to Chicago, New York to the shows. I met the reps and I visited all these point of sale people, and they're all different programs. Some have resellers, and they'll tell you like, oh, we have 50 resellers, but once you're integrated, probably send you to about 10. And they're probably the ones who can do business with you. And so each partner is going to be a different partnership play. But I feel comfortable with that, multiple reasons. No one else in the industry is going this route. I'm going this route, and my entire career has been in, partner. I've been a VAR, I've been a vendor, I've been a distributor, et cetera. Okay, so the lead competitor validates the market. It's Hot Schedules. They raised $20 million. They got a lot of corporate stores, but they don't have all the franchisees, and I'm talking to some of the franchisees. The second-tier players might be Schedulefly, When I Work, and a few others, depending on the country or the regions. But there's 650,000 restaurants to target, and and there's lots and lots of market space. There's still people using Excel or even I went to a big hotel and they put a paper on the back wall for the schedules when I asked the guy. So these partners, I have a list of 50 of them. I've signed 10 of them. They have between generally 5,000 to 250,000 clients. The two big ones are 250,000 clients, and then there are lots of 5,000, 10,000 client point of sale companies. So our partner situation puts us in front of about 350,000. So it could be 550 pretty quickly if we got a little money, because Oracle, who own Micros, want money to do the integration. The revenues I just guessed, I'm just going to have to skip that point and go to the next slide if I may. So we have a partner signed. He has a complimentary system. It's integrated. He's doing the launch. He's paid us to do the integration. We've done it. He's marketing it. We're getting almost every day now, every 2 days, we're getting a new sign up. And the deal we're doing with them is we're splitting 50-50, and then it's going to be 60-40. For a 6-month, 3-month, 30-day trial, and then 6 months at a reduced rate, and I'm sure they'll keep it and keep going at regular rates, and our regular rates are very reasonable. We have another plan to get strategic corporate clients. Is with the franchisees, I'm saying, hey, free for life for the first store. You act as a reference to the other stores, help us move around corporate and get to other franchisees. That's the strategy for that. And then, like I said, we've got 10 partners. Next slide, please. That's traction. So we need fundings. So these are my questions. So you may have some questions first, or how do you want to proceed with this?
Why don't we listen to your questions, and then both Ashmeet and I are going to give you feedback. Go ahead.
Thank you very much. So we need funding now. Like, you can see why we feel that, we want to write an API, we want to do the integration, we want to do the marketing with these guys that I've built relationships with, the point of sale and the payroll guys. And you mentioned Paychex. I'd never release it, but that's the other one that's agreed. And I wanted to put the development with the Canadian dollar at 70 cents. Unfortunately, it's a good thing for those who manufacture and export, and Ottawa is a great place. It's English first. I can't sell the product in Quebec because it's French, and that's where I live. So I started to do a little marketing in Ottawa because that's where I want to put the development and their different programs, et cetera. So we need to build a development team there. I've been an entrepreneur for 28 out of 56 years of my life, but I never took investors. It's my first partner. We get along. We're very complementary. But it's about valuation and dilution, you know, and how do we find the right, you know, when I say partner, I'm now referring, because there are three types of partners, right? But in this case, I'm referring to, because I don't refer to the investor as I'm thinking of him as a partner, you know, so let's call him the investor. And then, you know, I've been told in talking to some experts, various types, you know, an angel group, and then a Silicon Valley guy that I knew that worked with Vinod Khosla, and then I spoke with VP of strategy of a big telco in Canada. And they range, you know, from, you know, depending on their outlook on life, you know, between 2 and 10 million we're worth, given where we're at. Who knows? And your Facebook article said, like, okay, he was 5 million and he took 500,000, he gave away 10%, if I understood it correctly. You know, and then we have some structure questions about, but I think it's pretty easy. I mean, US LLC something.
So Martin, I think we've got your questions. We don't have time to do all this, but I want to give you some feedback. I want Ashmeet to give you some feedback.
Yes.
I will start. You know, what I like is that I think you have a partner who understands the restaurant management business quite well. And from what you're describing, it seems like that has been worked into the software. What I don't like is you're going around signing tons of partners without signing any customers. And that is really problematic for me. If I were considering investing in this company, I want to see a bunch of customers who are actually paying instead of, you know, big name partners who, you know, we don't have any validation on whether they're going to ever pay or not. So that's the part that makes me very uncomfortable. Ashmeet?
Respond quickly to that? Can I address that quickly?
Sure.
Thank you. So customers, it's a very tough market, the restaurant industry. If you look up 4f.io, you'll see all the players. A lot of them are probably going to drop off the map. The way we got customers is through our first partner deal. I spent major efforts, and you're talking to a guy who's put $500,000, $1 million systems in place. I signed OEM agreements with large corporations, et cetera. It's very, very tough to sell to restaurants, and it's peanuts per month, but they're challenging. So what I did was the guys who have customers, I've made deals with them. So the first one is doing exactly what you say, and we're now at the stage where we're starting to get those customers, but it's because he has those relationships. They're already doing business with him. It's a very tough market to crack. Many companies will fail in the restaurant services market with IT. So that's how I'm doing.
And that is part of the problem. This is not a $500,000 or $1 million system integration deal with a large enterprise. These selling to these small businesses is a very tough proposition, and I think it's a very different business, a different business of a different cash flow situation, different growth rate, etc. I want to hear what Ashmeet has to say. Ashmeet, please weigh in.
Shavana, I like your questions. I think the advice which is implicit in those questions completely resonates with me. I would leave you, Martin, with the question of why now? You know, you've described a business and a market where there are lots of players, lots of people participating. Why are you doing this now, and what makes your company which will succeed? Until you can truly articulate that distinction that makes you differentiated and better, it feels like more of the same, and that's the real question you have to answer. What is different about you? Why are you doing it now, and why would you succeed?
Okay, so there's a tipping point. Shift, swap, drop, and add are still not being used in many, many, many stores, and in their many other vertical markets. The fact is that once the tipping point occurs, I believe that people, managers and employees, staff types alike, will not take the job if they are not able to shift, swap, drop, and add through their phones.
So Martin, then you need to answer why has this shift, drop, and add not been implemented so far, and what are you doing which will make that happen? You haven't, I didn't hear the reason which makes your software something that will make that happen for the customer. People are using Excel, PDF, existing point of sale. There's been a lot of players in this market.
Yeah, so it's a valid point. It's tough in a 5-minute presentation, but the Hot Schedules company are aiming towards corporate, large markets. They're not that flexible. They raised $20 million about 4, 5, 6 months ago to put more people on the street to go after that corporate market. But the franchisees are not buying from Hot Schedules, and we're starting to get some success in a lot of these franchisees. There's room in the market for many players, and I believe that our system is very easy to use. It's got some strengths, and I just believe there's a big enough market for us to generate millions of dollars a month.
So Martin, I'm afraid we've come to the end of your allotted time. We've already gone over your allotted time, but I think if you are going to look for investment, the level of scrutiny is going to be much, much higher, and you're going to need to show that you can actually sell to some segment, and what that segment is. You're talking about franchisees, then we need to see evidence that you have been able to sell substantial franchisee deals and so forth before any investor will engage. Because to me, the fact that you have a whole bunch of partnerships says nothing if you cannot turn that into any kind of revenue-generating customers.
That's what the first partner is doing.
We don't have more time. Sorry, Martin, I'm going to have to cut you off there. Otherwise, we won't be able to do the other people. You have to give other people a chance. Jonathan Kaplan is next. Thank you, Martin, for your presentation.
Yes, good morning.
Good morning, Jonathan.
So my name is Jonathan Kaplan. I'm the CEO and founder of Build My Bod Health. Next slide, please. Build My Bod is an online marketplace that provides for price transparency in healthcare and the ability to purchase non-surgical services online. So even though you may have health insurance, chances are that you have a high deductible health plan like 164 million other Americans. And if that's the case, that means you'll be spending $1,000 to $6,000 out of your own pocket before your insurance kicks in. Next slide. So wouldn't it be nice to know how much it's going to cost you before you get your medical bill? And that's where Build My Bod comes in. Build My Bod is a patented platform that allows healthcare providers to showcase their services to consumers through an app. Next slide. There's an app on the Apple Store, and also on a website, as well as a widget. We can embed this widget into the individual doctor's website, which is in the next slide. The consumer receives cost information immediately from our doctor-provided pricing database, and the doctor gets the consumer's contact info in return, a lead. And as you can see in this slide, neither of these two things, which are mentioned, immediate cost information from a doctor-provided database and also a lead for the provider, neither of these two things are provided by anybody else in this space, and that's what makes us special. Next slide. We have $140,000 in revenue, and this is from over 100 physicians and facilities paying subscription fees to use our platform to provide pricing information to consumers. And then also we have revenue from commissions paid by consumers that are purchasing non-surgical services on our website, which you can see in the next slide. So as you can see, is not only can they check pricing through our platform, but they can also purchase non-surgical services through the healthcare provider's own website through our embedded widget.
Jonathan, can we go back to the previous slide for a moment? I have a question.
Sure.
When you talk about $140,000 in revenue, which of these business models is generating that revenue, bulk of that revenue?
Yeah, we just switched over. The 50% market used to be mostly subscription fees, and 60% subscription fees, 40% commissions from non-surgical services being purchased, and we just flipped over to now it's more getting revenue from the commissions on purchases versus the subscriptions. So.
And what is an example of a non-surgical service that you sell online here?
An X-ray, a lab test, Botox, fillers, teeth whitenings, home teeth whitening sets from a dentist, skincare products from a dermatologist. But also, the bigger items are going to be X-rays and lab tests from outpatient facilities. So we can go to the next slide. So I already talked about the purchasing, which can be done through the embedded widget. Next slide. All right. So we have over 9,300 registered consumers using our platform. And in the next slide, from that, those consumers have submitted over $118 million worth of submitted wish lists. Now, while we don't get that $118 million, the point is that people are curious enough about the cost of different outpatient services in healthcare that they're submitting a lot of wish lists. So these are big ticket items, and if people start purchasing these online more than they are now, this is where we're going to be getting an even greater revenue. Next slide. So we're seeking $2 million. Let me start off is that as a plastic surgeon, I'm familiar with the out-of-pocket marketplace enough to know that even when you're getting something medically necessary, chances are you'll be paying a portion out of it out of your own pocket. And we're requesting $2 million for our team, a team that includes software engineers and technical co-founders from Carnegie Mellon to expand our practice, to expand our price transparency platform to hospital outpatient facilities, labs, radiology, medical tourism, urgent care centers, and other assorted physicians. In the next slide, we want Build My Bod to be the universal source for price transparency in healthcare so that when a consumer needs some sort of a healthcare service, they'll be going to our platform, our website, or they'll be going to the doctor or provider's platform or website to check pricing. And in so doing, we'll be able to bring in $18 million in revenue over the next 3 years. Our goal is for every American with or without health insurance to know their out-of-pocket cost before seeking out healthcare services. Thank you so much for your attention.
So, Jonathan, are you proposing that this $2 million investment is the only investment you need to deliver $18 million in revenue over the next 3 years?
It is, because since we already have revenue, and then with that infusion of capital, that'll allow us for more marketing and expanding to go out to other healthcare providers and be more aggressive with getting more people on our platform. Because the more doctors and pricing we have in our database, the more useful our platform is to consumers, and so that it will just continue to grow. So it's not $2 million that we just throw in there. We also have revenue that will complement that.
Well, it seems like you have worked out the customer acquisition strategy and what it costs to acquire customers and so forth. I'm assuming that you're not just like throwing these numbers out. They're based on some financial model underneath, yeah? Yes.
I mean, obviously, from the revenue perspective, you'd be able to see that in our QuickBooks where we have all that revenue generated. But as far as the $18 million, yeah, we have a pro forma that we put together. Now, I'll be the first to admit that a pro forma is based on the future, and so that, obviously those things aren't guaranteed, but no, these things have been vetted with our accountants and our tax attorneys and things like that. Well,
it's not so much accountants who vet these things. What I'm interested in is, do you understand the unit economics of customer acquisition and how that, what is the lifetime value of a customer? These are the kind of things. If you look at an investor, if you put on an investor hat and look at this presentation, that's what I'm interested in, is what is the cost of customer acquisition, what is the lifetime value of each of these customers that we acquire, and does this 18 million emerge out of those numbers, or is it some kind of some more guesstimate kind of thing? No. You may not be able to answer this question right now, but this is the key question that investors are going to want to understand. Because your points are very good. The fact that you're already in revenue and you have a value proposition that is validated, all this is great. $2 million to $18 million, $2 million in, $18 million out is a very nice equation. I don't have a problem with that. Ashmeet, what do you think? We've lost your audio, Ashmeet.
Can you hear me now?
Yes, go ahead.
Okay, not sure why it was on mute. But the pitch, the way I would say it is, the pitch itself was very well done, and it really addressed all the important points. There's a question of due diligence, which is, if everything which you say in this pitch makes sense, this would be a nicely fundable business.
Yep.
The question now becomes, why do you reach these numbers, how do you reach them, et cetera. So I would commend you on the quality and the way in which you built this up, and also the fact that you have revenues already is great. The only question I would leave you with from a venture investor, and this will not be true for all investors, $2 million in, $18 million out is a good business. From a venture investor perspective, the total market size may not be big enough. What could you get to in 5, 7, or 9 years? Could this become a $100 million business, a $200 million business? And if that is the case, then this may well be a venture-backable business.
Right. That pretty much summarizes all my thoughts, actually. There's a TAM question, which makes it venture fundable or not. But regardless whether it's venture fundable, $2 million, $18 million, $2 million in, $18 million out is a fundable business. May not be venture fundable, but it is certainly fundable.
So you're thinking more of an angel investor then?
Depends on what kind of angel, Jonathan. Some angels are just basically feeders into the venture industry, so they would evaluate it in the exact same way as a venture investor would. But there are other angels or other, private investors who would look at a different model of investment, and so you need to find the right kind of investors. But I would encourage you to do the TAM analysis, do the TAM modeling, and if you need help with that, we can teach you how to do that. But do a good, solid bottom-up TAM modeling and see what kind of TAM are we talking, in which case it may also be a venture fundable business.
All right. Thank you very much for your feedback.
Yeah. Don't limit yourself to 3 years. I mean, 5, 7 years is perfectly fine.
Yeah.
Thank you.
Good. Jonathan, excellent presentation. Very crisp, very short, and very effective. Michelle Elise. Michelle? Are you on?
Can you hear me?
Yes, we can hear you.
Okay. I'll hold the phone closer. Thank you for having me. Ashmeet, thank you for the very informative talk. I appreciated that. One of the things is I need to be a very personal, amenable person to be approached to. So I always introduce myself with my animals. Well, one of my animals that does work with me is my dog. But this is my Arabian horse of 17 years. I live in Denver, Colorado. We just had 8 inches of snow, and it's snowing again today. It's wonderful. And I'm also a self-taught gourmet chef. So I'm a very approachable person to all kinds of people, and particularly when we're dealing with personal issues, whether it's trauma or changing perspectives from our lives from a small experiential perspective that has been a small town area where a person's lived and they have not expanded their perceptions through cultural and travel. So I'm a person that is a very approachable person. And next slide, please. My company is the finish line is our starting point. So many people come to trauma and through experiences, and they are in a suicidal point, and they feel their lives are at an end because they see no area that they can change. They feel like they are in a prison, and it is traumatizing, but the recovery point is what has not been taught, and it is in the behavioral area. So this is what I teach people. Next slide, please. The facts with trauma, and particularly traumatic brain injury, which we will call TBIs, over 10 million people worldwide are affected annually, and this is on the increase. Most traumatic brain injuries are affected by falls, which are 40%. Next comes car accidents, which is 25%. Then we have 15% in soldiers. And it moves from there. I personally was set up, back slide please. I personally was fed up with the recovery knowledge because no one understood traumatic brain injury and how to recover through behavior. They did not understand the internal conflict and agony that people were going through. People feel the same person within inside themselves. Unfortunately, they cannot exhibit that person on the outside because the brain is misfiring through all different sections of the brain. So I come in and I teach people about neuroscience and behavior combined, whether that is a company, because where I was injured was when I was going into work. And I fell, and I went through 8 years of surgery and 9 traumatic brain injuries in 11 years. And I had to figure out for myself through my psychology and behavioral science how to recover, and I did 100% to over 100%. So studying animal instinct and human behavior gives me more insight as to what we are capable of doing. Next slide, please. Oh, and that little dog, she's my trauma dog. She works with me. I work with and speak to individuals and groups, companies on behavioral change in our work environment and in our everyday lives. I utilize behavioral and neuroscience in tandem to augment personal and employee interaction. Recognizing a multitude of post-concussive syndromes, guiding injured individuals and caretakers to further their recovery and back to work modales, and understanding the intricate details of how a person is dealing with different traumatic incidences. Seeing adversity as an opportunity. This is something we are not taught in our societies, is taking adversity in our lives and changing that perspective to see opportunity. So we take changing perception and experience in life, which are not the sum total of our life, only a reflection, stepping out of behavioral boxes. We take this reflection of self out into the world and expand our horizons, seeing life as a renewed vision, and we expand and change these values. I'm going to skip a little bit. I joined up with community projects, offering ideas through education and seminars, mentoring, volunteer, and simply connecting people to other needs and resources. I'm formulating a huge resource page and being able to connect other people to whatever resources there are. And thereby they give me resources such as Brain Injury of Colorado. And I've signed up with them and I give speaking hours and presentations to them. I also write articles and blogs, and I am working on 2 books at this point. So that is...
Michelle, what is the business? What business are we talking about here?
It is a psychology, behavioral, and neuroscience recovery programs.
Okay, and is this business already running? Is this in concept stage? What is the stage of the business?
It is in concept stage, and I am taking this time right now, this month, to compile the next book that will be put online as far as recovering from traumatic brain injury, but make this very personal so that people can relate to it. I have already written 1 book on trauma recovery. It has 610,000 words I need to edit, but I'm going to put that on the shelf because it is something that needs to come afterwards, because traumatic brain injuries are on the increase.
Okay, let's go to your questions.
Yes.
So while we're going through the questions, if I may interrupt for a second.
Yes, please.
The fact that we had to ask the question of what your business is, I think should be one of the main takeaways here, which is if you had started, you gave such a nice description of what your business is when you were asked the question, but that wasn't obvious from the slides while we were watching.
Okay.
I would start up front with that and saying, this is what I do, and is it, and it's still not crystal clear to me whether you offer a service, as in you are personally offer this service to potential patients or users, or are you providing content, as in, you create content which is used by users?
Actually, both. It is creating content as far as reading, and I do go in personally. But thank you for that suggestion. I will use it and revamp.
Great.
So,
go ahead.
Michelle, I think what Ashmeet is telling you very gently is that we essentially wasted, about 5-7 minutes without any understanding of your business, and that is a time you're not going to get this time again. So you basically wasted an opportunity to actually discuss business strategy by spending a lot of time on things that are kind of interesting, but they're not necessarily beneficial for you to move forward with your business. So, and now we are running to the we're not going to have enough time to discuss your business strategy. That's what he's telling you.
Yes, thank you.
So, are we going to spend a lot of time helping you figure out where to publish your books, how to publish your books? I'm afraid not. That's not what we do.
No, I have people
how do you
work with
approach
me.
organizations for educational speaking engagements? Well, again, you know, you have to establish yourself as an authority who's being sought by your community, your segment, you know, whether it's trauma therapy or that segment, to be invited to speak, and then you have to figure out who pays. You know, part of a business is who pays. Where is the money going to come from? So if you're looking for paid speaking engagements, that's a whole different ballgame. Then you need to kind of zero in on a set of organizations who are willing to pay you to come and speak to them. And for that, you need to be positioned even more as a thought leader, as an expert in your subject. So I mean, these are very long conversations, and I'm not sure that that's the best utilization of this forum.
Okay. Thank you very much.
So, you know, in terms of constructive stuff that you probably can take away from here and work on is, I would suggest that you figure out what is the business you're going to be in, and the number one point in every single person who's working on a business is, where is the money going to come from? Who are the customers? What is the revenue model, and where is that revenue going to come from?
Okay.
You need to think through and answer those questions in very granular, very precise terms. Otherwise, there is no chance to build a business. And I'm assuming, all this while, I'm assuming that you are here because you want to build a business.
True.
Okay, so why don't you take those 3 questions and really work on those questions, and I'm going to spend some time shortly explaining how to use 1 million by 1 million. And you can see if that's a forum that you want to use to learn how to do these things. Ashmeet, do you want to add anything to that?
Yes.
No, I think clearly articulating who the customer is, what they will pay you for, and how much will, I think, really simplify the way you're approaching it. I think you're offering a very valuable service. Unfortunately,
thank you.
Or I should perhaps say, fortunately, I don't know anything about traumatic brain injuries, so I can't offer any advice on the market. But really knowing your customer is a truism which you cannot go wrong with.
Okay. Thank you very much.
All right, folks, I'm going to spend just 5 minutes explaining to you how to use 1 million by 1 million, and then we're going to open up the line for Q&A. One request that we have is that if you like what we're doing here, please refer serious entrepreneurs into 1M1M. And the word serious is very important, because we are, you know, we can only make successful those entrepreneurs who are willing to put in the work and who realize that building a business is a many, many years effort. It's a marathon, not a sprint, and it's going to require immense amount of hard work. So that is the style of entrepreneur we're looking for. We're not looking for people with misconceptions that entrepreneurship is some get-rich-quick scheme, and you can, you know, do something here and there and then flip it for many millions of dollars. This is not the kind of entrepreneur we would be able to help. Okay, so everything in terms of resources is at 1mby1m.com. You will find a terrific content-rich blog, which you will learn a lot from. The whole spirit of the blog is education, information, and inspiration. So you will score on all 3 counts if you follow the blog, and we always bring interesting guests who again, deliver on all those counts. And then the Entrepreneur Journeys book series that's available on Amazon Kindle, it complements that. It's you know, these are very inexpensive books that you can also get into the program with and start, you know, following the methodology. Each of the books double-click down on a specific topic. It could be cloud computing and Carnival in the cloud. Could be e-commerce, from e-commerce to Web 3.0. It could be bootstrapping using services or bootstrapping with a paycheck if you want to learn the nuances of those techniques of bootstrapping. Billion-dollar unicorns is a treatment of this topic of how to build these billion-dollar companies and what we have learned across, you know, 16 case studies. So each of these books have 12 to 16 case studies, and we, you know, double-click down on the topic at hand with those case studies, with entrepreneurs who have experience in those topics. Otherwise, you can go to the website and you can come back to these roundtables and keep following these roundtables either live or in recording at on our YouTube channel. You need to register to pitch or attend at the website. Our premium program is $1,000 annual membership for extensive methodology guidance. We have a terrific curriculum that has been in the market for 5 years now. We have had over 600 entrepreneurs, VCs, people who have extensive experience in building businesses participate in building this curriculum, and we answer a tremendous number of questions that are important questions in your life, in your journey as an entrepreneur in this curriculum, and it's in a very compressed format. You can really accelerate your learning curve, especially if you're a first-time entrepreneur. This is an immense learning curve that you're going to have to travel, and we try to give you an accelerated path to travel that process. We help you with business development, we give you extensive strategy consulting, and we also help you with financing and media relations. On the website, you'll find success stories in the $1 Million Club. You'll find an ROI analysis of the program. We offer $375,000 worth of value plus 5 to 10% of equity worth of value for just $1,000 annual membership fee and no equity. This value proposition is not available anywhere else in the market. So just run through the website and familiarize yourself on what to expect from the premium program. We have video FAQs answering most of your questions. The curriculum is taught in case studies and video lectures, and we have, as I said, over 600 entrepreneurs and VCs participate in developing this curriculum. So you will learn a lot from it. Our methodology is lean, capital-efficient, bootstrap startups. Even if you raise money, we would want you to do that bootstrapping phase so that you can show a validated, idea to the investors. And if you don't want to raise money, that's fine too. Not all businesses should raise money. Not all businesses can raise money. And raising money does not equate to success. You can use our channels. We have extensive presence in media and social media, so we do make that available to you to get the word out, and we will help you get your message out there through our channels. If you are trying to build a community anywhere in the world, an entrepreneurship community, please feel free to work with us, and you can become an affiliate partner to the program. Upcoming free roundtables every weekend, every Thursday in January, basically we are here, so we'll have lots of slots available for you. An Incubator in a Box is our program that we work with corporations and governments to run incubation programs for them. So we have major Fortune 500 technology companies as well as government partners that use our Incubator in a Box platform. That's it pretty much in terms of how to use the program. We have some time to do Q&A, so please line up your questions, call in if you'd like, follow the instructions on your screen, or just put in questions in the public chat, and Ashmeet and I will pick up the questions from public chat and answer as well. If you're dialing in, let us know in public chat that you are dialing in so we know how to call you. So, folks, what did you learn? What questions came up in your mind as you listened through this session, walked through this session with us today for the last almost 90 minutes? Dean Owen is asking, when is the right time for co-founders to decide who will be CEO? Very good question. Very, very good question. Ashmeet, do you want to take it?
I agree with you. It's a very good question, and it's good because it's such an important question that you really need to answer, which is who is the leader of the company and how is that leadership going to be decided. In my opinion, the right time is if you have to ask the question, it's already too late. In other words, you need to start as early as possible to have clarity on what are the different roles, who's going to perform what function, and how you will grow as a team to make it happen. And the team really does start with the CEO. So start early.
I couldn't agree more. I think, going down a co-founder path without deciding who is eventually going to be the CEO is a recipe for disaster. Other questions? Ashmeet, what did you think of the session today, and what other thoughts do you want to share with our audience?
I enjoyed the session. I must say it was it's the first time, obviously, that I'm participating, and so I wasn't quite sure, what to expect over there. But it seems that you and I view entrepreneurship through the same lens, and so I very much appreciate that, which is about building true businesses in a sustainable basis with revenues and profits. And it's really not a game about funding or demo days or trying to get in front of as many investors as possible. Those are side effects to building great companies. There's also a certain practical wisdom in terms of how companies get built, which is a day-to-day, blocking and tackling. And I think you were getting into some of those elements, just beginning to touch upon them as you talked about customer acquisition and addressing them. And really, the scale of your operation is commendable. On a 1 million, just when you start with that number, you have that right in your name. It's such a fabulous goal and very impressive. So pleasure to have been here today, and thank you for including me.
And thank you very much for being here. It was really, really great for our audience to have an opportunity to listen to you and dialogue with you. So here's Arindam Chakraborty, who's asking, how do you identify risk in any venture when you think of investing? Ashmeet, the question is for you.
Risks come in two broad categories, known risks and unknown risks. So the unknown risks are the things which you don't know, and so by definition they cannot be known, and so we'll exclude them for now. These are things which happen in the future when things change. But known risks are things which come by studying and understanding the problem you're trying to solve. At the end of the day, over here, we are talking about entrepreneurship, and so broadly speaking, the problem is how do we build a company? To build a company, you need customers, you need a product, you need revenues, you need profits. That's the problem. And so what are the risks associated with each one of those elements? Those become the known risks, which you can understand. For example, what is the cost of acquiring a customer? How much will it cost to build this product? Will the product work? Will the product fail? In what ways could it fail? All these are examples of risks that you go through. And of course, the most important input into any startup is the people, and so there's all the people risks which come along with it. Those are the types of risks you have to study. Knowing exactly what that risk is can only come by studying the actual case, which is why this is a craft. This is not something you can generalize by saying, I know all the risks. You have to study each one individually and say, oh, that's what I think the risk is over here.
Arindam, I'll add one thing to what Ashmeet said so far, which is all points that I agree with. One thing is that a good entrepreneur actually tries to mitigate the amount of risk they take. So you have to kind of take calculated risks and figure out, yeah, here are some risks, and then I'm willing to take these risks, and I know how to handle those risks to an extent, and here are risks that I don't want to take. So the success in entrepreneurship is actually about risk mitigation, not necessarily, brash risk taking. Even though, as entrepreneurs, there's a certain amount of risk taking built into your psyche, your persona, your ability to handle uncertainty. That is who entrepreneurs are. Good entrepreneurs have all that built into their persona, but actually when it comes to execution, what you're trying to do is mitigating risks as opposed to taking brash risks.
I couldn't agree more. The more you can reduce the risk, the better off you are.
Yeah. Okay, well, Ashmeet, thank you very much for coming. Thank you for spending the time mentoring the entrepreneurs, and I'm sure everybody appreciates very much your being here and sharing your wisdom. Folks, if you have questions about the 1M1M program, feel free to contact Irina Patterson on our team, Irina at 1mby1m.com, and she'll be happy to handhold you to whatever questions or roadblocks you're facing in terms of understanding the program. If you choose to do your entrepreneurial journey with us, we will do everything possible in our power to help you. And happy holidays. We are not going to be here for a couple of weeks because it's Christmas and New Year's, next 2 weeks. Have a wonderful end of the year. Those of you who are actually actively running companies right now, be sure to charge your batteries. This is a good time to connect with friends, family, eat a lot of good food, and just feel good, you know, because we are running a marathon. You know, I've been running 1 million by 1 million for 6 years now, and a core part of the 1M1M team has been with me for 6 years. So we are, you know, we're all human beings. We have needs, right? We can run constantly only up to a point, but you have to kind of recharge your batteries and get all the other things that you need to be able to again run at very fast pace for months and quarters and years. So don't underestimate your needs for getting the TLC from your community, and good luck everybody. Happy holidays. Ashmeet, happy holidays. Hopefully see you soon in the new year, and thank you again.
Thank you, Shamana. Happy holidays, everyone.
Bye.
Bye-bye.